So a recent poll done by Resourceful showed that 46% of Canadians believe immigration is mostly having a negative effect on Canada, being up from 6% of last year, and it's becoming very easy to see why this is the case. Canada is a country that used to be nearly perfect, but the downward impacts of an immigration influx combined with many other factors are consistently draining its current system and causing it to fall apart. So in this video, I'm going to cover the truths between Canada's economic and financial crisis, why this current system is failing, and what you can do as a Canadian to stay ahead. So geography always used to be the heart of Canada's economy, and it was known as one of the most resourceful countries in the world. It was a primary leader in fur, logging, and fishing until being a major exporter in oil and hydroelectricity. Alberta's oil fields eventually became the lifeblood of the economy, but the core of Canada was always resources and the reason why its economy grew at such a fast pace. Aside from that, Canada relied heavily on expanding major US franchises, with many manufacturing operations serving as branch plants for giants like Ford, General Motors, Heinz, Kraft, or even Campbell's Soup. The country was on a great run and known to be one of the wealthiest and fastest growing economies in the world. But if you fast forward to today, it's evident that things have taken a wild turn and Canada has become one of the slowest growing economies in the world. There's many causes to this, but let's start with the most prominent reason. There's a sufficient decline in productivity, and Canada is not making things at the rate they used to, which has made it less resourceful and productive than it once was. Now economists have a straightforward formula for understanding productivity, which says the more output a worker generates, the more wealth a nation generates. Productivity is the key to driving wealth into an economy, and it's the engine that propels economic prosperity. With that said, Canada's productivity growth has hit a standstill, resulting in diminished earnings. Canadian workers are now behind their American counterparts by 40% in productivity, translating to an average annual income of $44,000 for Canadians compared to $57,000 US for Americans. This comparison goes to show the need for Canada to re-establish its productivity and reclaim its competitive edge on the global stage. The decline of productivity and being less resourceful has led to a downshift in a fast-growing economy. As an alternative from its downfall, Canada transformed from a resourceful economy into a money grab scheme where people started buying and selling houses for substantially large amounts of money. Dramatic spikes of increased house prices really started during the 2008 financial crisis, when the World Central Bank announced that they would decrease the interest rates in an attempt to stimulate the economy. The Bank of Canada did the same and dropped their rates to nearly 0%, even though they didn't need to, since their economic situation was completely fine. Mortgages then became extremely cheap to borrow and house prices started going up dramatically. At the time, 70% of Canadians owned their homes, felt richer and invincible since the housing market in the US went bust, while Canada kept progressing. Year by year, house prices in major cities like Toronto and Vancouver grew by double-digit percentages and started looking like a massive housing bubble that never busted. In 2014, the next phase of Canada's decline started when global oil prices collapsed and fell by a half a mark in that year. Oil used to be Canada's most lucrative explorer, but investment in the oil industry started declining after the crash. The government and businesses started avoiding oil, and everyone put more emphasis on buying and selling homes. The flow of money steered away from resources and shifted into real estate, and the surge of immigration placed more pressure on construction to keep pace with the demand of new homes. More money flowed into the construction of new residential real estate, while Canadian homeowners shifted their focus and poured more of their wealth into real estate and less into traditional avenues like the stock market and other investment. It got to a point where the influx of capital being dumped into the housing sector exceeded investments in business and all other industries combined. Because of this, it has pushed Canada into a totally imbalanced economy with many effects on the country. This is why Canadians are not as productive as Americans. They don't have access to the same kind of resources that the States do. They work with older equipment, older computers, worse software, and outdated factory machines, which just leads to less production. The shift towards housing and away from other sectors has created a devastating affordability crisis in Canada. Between 2010 and today, the average house price in Canada has tripled, while the average income has plateaued. It's been a disaster for millennials and Gen Zers trying to break into the housing market, and these challenges have only escalated since COVID-19, and here's why. The pandemic, the Bank of Canada once again lowered variable interest rates to nearly 0%. It was sitting at an average of 0.99%, which prompted prompted an influx of borrowing since Canadians rushed in to capitalize on rising house prices. Many people jumped into the market thinking they would miss out on home ownership, which just drove prices even higher. Between 2020 and 2022, house prices increased by 50% and eventually triggered inflation. In response to this, the Bank of Canada followed the global trend and raised interest rates, which caused more devastating effects on the housing market. To put things in perspective, consider mortgage rates in Canada, which are typically offered on a 5-year term with the choice of a fixed or variable, also known as floater rates. On a fixed rate, you're basically locking in the rate at a 5-year term, but a variable rate is open and changes based on the Bank of Canada. So if they decide to increase the rates, the variable rate goes up the same way. During COVID-19, variable interest rates were significantly lower than fixed rates, which enticed buyers despite the risk that came with it. Approximately 1/3 of Canadians, about 33%, chose variable mortgage rates at the time. And when the BOC rates increased, those on variable saw their mortgage costs increase monthly, and those on the fixed rates saw steep increases after their 5-year renewal came. And this led to a lot of uncertainty and unexpected financial strain, while many Canadians started to panic. But in order to avoid a US-style housing crash, the Canadian banks increased the length of the amortization period, which basically meant increasing the amount of years it took to fully repay a mortgage. This adjustment lowered monthly payment rates but significantly prolonged the repayment timeline. And because of this, homeowners are now finding themselves stuck with mortgages that will take 70 to 90 years to pay off, trapping them in a cycle of permanent debt slavery. It became near impossible for first-time buyers to purchase a home because of the high prices and rising interest rates. Real estate transactions slowed down, but not as much for existing homeowners who had the ability to use their existing equity as leverage to fund investment property. A recent article by the Global Mail showed that fewer than 10% of Canadians can afford a home on their income, assuming that they had a $160,000 down payment. The affordability rate continues to decrease in relation to the market trends, and the housing shortage crisis continues to be more problematic in our world. The problem is that this rapid population growth has outpaced the underinvested economy to keep up with its pace. The repercussions became obvious during the second quarter of 2002 when Canada slipped into a per capita recession. While the economy continued to grow overall, it shrunk on a per person basis, which has led to reduced job vacancies and insufficient economic expansion to sustain previous levels of wealth that people once had. So with all that said, this is where the country is currently at, and as promised, here are some actionable solutions that you can consider to navigate and thrive through the crisis. Number 1 is diversify investment. Consider diversifying your investment portfolio beyond real estate. Even though housing has been a popular investment avenue, exploring opportunities in stocks, bonds, cryptocurrencies, and other assets can have a greater resilience and growth potential. Number 2 is invest in skills. With job security being as unstable as it is now, do what you can to invest in new skills or enhance the skills that you have. This will only help boost your employability and open up opportunities in the fields that you already have a talent for. Search for training programs, certifications, or educational courses that are appropriate for high demand industries. Number 3 is consider entrepreneurship. If you're facing limited job prospects, entrepreneurship offers a pathway to create employment opportunities and build wealth. Explore ventures that are aligned with your interest and expertise and take advantage of online resources and networks for support. If there's someone you know or can reach out to who specializes in a field that you have a higher interest in, find a way to volunteer under them so that you can shadow their line of work and get more experience under your belt to help build your skill. When I first started my career as a legal professional and insurance advisor, shortly after I worked at a law firm and a reputable company for a year, which definitely helped me gain enough credibility and pick up enough relevant skills to start my own company and build my own book of business. Number 4, stay informed and adapt. Make sure you're on top of the economic trends, policy changes, and market shifts. The key here is to remain adaptable and proactive in adjusting your investment strategies or exploring new career paths. Things are moving very quickly, and one of the best skill sets you can pick up is the ability to adapt quickly so you stay ahead of your competition. And last but not least, stay on top of your financial planning and budgeting. The outcome of your results from a crisis heavily relies on your financial foundation, and you should treat it with the highest priority. Budgeting to weather economic uncertainties, creating emergency funds, prioritizing debt repayment, investing in life and living benefits that pay you in the event of an accident or sickness, and adopt frugal spending habits to safeguard your financial well-being. These effective solutions can help you navigate the potential challenges from a crisis and come out even stronger. Remember, knowledge is power. By staying informed and taking proactive steps, you can navigate these challenging times with confidence. If you found this helpful, don't forget to like, subscribe, and turn on that notification bell to stay updated with similar content. If you wanted a more in-depth analysis on physically and financially preparing for unpredictable waters of a black swan, then be sure to click here and watch another video I released that illustrates what you can do to stay ahead. Until next time, stay safe, stay informed, and stay ahead of the curve. Take care and bye-bye.